right. Good morning, everybody. We are sans Austin for a few minutes. He's on a client call real quick, but he's going to be with us in about 2 minutes, which will be good. Just so to start this off, of course, my name is Mike Perna with the Perna team with Keller Williams. Austin Pothast, who will be joining us in a minute, is our director of sales. I'm actually looking at a text from him. There we go. And he will be with us in just a moment. Today, he said he had a couple of things on his mind he wanted to talk about. So I'm going to wait until he gets back, because I have no idea what the heck he wants to go over today, but I'm sure it's going to be amazing. We are the Perna team with Keller Williams Realty, located in Southeast Michigan, selling around 800 homes a year. This year, actually, we're probably going to go a little bit north of 1,000. In the meantime, guys, everybody, bring your questions. Throw them in the comments. It has been a crazy real estate market. I'm sure there are a ton of questions and a ton of people out there that have a ton going on. Anyway, so I'm going to start with a little bit of a recap of what's been going on just in the past 2 weeks in the market. One thing that I have seen, again, the number of homes on the market has been rapidly increasing. And that is going actually faster rather than slower, which is good for a couple of reasons. One, I am starting to see just in this past week a little bit of media coverage, and this will increase over time, where we're not talking about how crazy the market is, how nobody's getting offers accepted, things like that. I actually saw 2 different articles saying, hey, in April, it's starting to loosen up a little bit. In April, offers are starting to get accepted. And frankly, that is the media and the news that we need, because there are a ton of people that have homes that they're looking to sell for whatever reason, right? They're looking to upsize, downsize, get to a different place in Metro Detroit or outside of Metro Detroit, that they're like literally just waiting, because what they're afraid of, and it's a very valid fear, is they won't be able to find that next home, right? Which, of course, the issue there is, the lack of inventory. So far in April, we are up yet another 20-ish% over last month as far as number of homes going on the market. So what we saw in February in Metro Detroit was around 4,500 homes go onto the market, which is frankly a very low number for February, extremely low number. What we saw in March was we saw that number increase to 6,500 or just north of, so almost a 50% increase. And frankly, that's not that far off from a normal March, right? So in the years past, looking back around 10 years, it's been hovering between 68 and 7,500 homes per March that go on the market. So 6,500 is still low, but it's not that low. And again, where we're seeing the pressure come in is just these astronomically low interest rates. A lot of people working from home, they want to get on to their next destination, because a lot of work from home is frankly going to be going on forever now. And which means you can also live anywhere, because you're not so much commuting to an office like you were before, right? Now, for April, we are almost at 4,000 homes going on the market, which means that we're probably going to hit a little bit above 8,000 new properties. That is considered a pretty normal market for here in Metro Detroit. The other thing that I'm seeing is there was an average per, and this is a great stat out of the multiple listing service. The average was, there we go. There's Austin. He's coming on in a second. The average was 4.2 offers to get an offer accepted. So an average buyer would have to offer on 4 homes, a little bit north of 4 homes, to get an offer accepted. Now that's the March number. That's a little bit different than in January, where the average buyer was offering on 7 homes to get an offer accepted. And now that number is moving rapidly down towards 3, which is brilliant, Once we get down below 3, I think we're going to see the news media pick that up pretty hard and say, okay, it's taking 2 to 3 offers per home. That's a little more reasonable. And then again, that news will again propel more people to go on the market, because they're not going to have the fear of being left homeless. Okay. Now, let me get this. Let me see if I can fashion this right. So 2 things I do want to note. Number 1, we have never left a seller homeless. So no matter what happens, right, we're always finding the properties for our sellers that turn into buyers, which is so great. And I understand, again, there's a lot of fear involved with getting the home on the market and then not having the next place to go. But number two, part of that also just goes to the length of time that we have in the selling process. So it's not an overnight thing, or it doesn't need to be an overnight thing. Like, we can completely slow roll a transaction pretty far, if that makes sense. And here's what I mean by that. So right now, just bringing a home to market, making sure that we do that right with the photography, the videography, the 3D imaging, the coming soon, getting it onto the market, doing the open house, that entire process is about a week, right? Now, once we're on the market, what we're seeing is, there we go. All right, Mr. Austin. Now, once we're on the market, what we're seeing is it's taking, if we get several offers right away, which is happening, it's taking between 30 and 40 days to achieve that closing for most lenders. There are some lenders that are working a little bit faster, around that 25 to 30 day mark. But the reality is, right now we're seeing between 30 and 40 days, because something's usually getting held up in the process, whether it's the appraisal, usually it's the appraisal, whether it's the appraisal or something else, or a re-verification of income that takes a few extra days. Like, as a good example, I'll use a Ford Motor, right? And General Motors for that matter. So before closing, on one of the newer requirements in the pandemic has been that lenders want to re-verify employment within 48 hours of closing, right? Which is great. It's so great. I mean, as long as you're employed, then you can do that. Now, there's Austin coming in. Hang on. Now, as long as I'm going to finish this thought, then we're going to go back and reintroduce you. But as long as you're employed, it's fine. Now, the problem being that Ford and GM are taking 5 to 7 days to return these calls right now on average, right? So again, we're really looking at a 30 to 40 day closing, not a 25 to 30 day closing in most cases. And then even further, most buyers are being prepped. Most buyers are are having the expectation set that they're going to have to give these sellers 45 to 60 days past closing to find their new home, close on it, and then move, right? So we're really seeing somewhere between 100 and 110 days from the point that we have a seller that says pull the trigger to they're actually turning over the keys. Now, in this market, again, where we're seeing the number of offers needed to secure a property coming down, not going up, and the number of properties going on the market already up over 20% month over month, a lot of sellers are looking at this and starting to say, okay, great, I can make that move. And guys, if you're a seller out there, you can actually make that move and not go homeless. Good morning, Austin.
What's up, buddy?
What's going on, man? How you doing?
Hey, I'm doing well. What did I miss?
We were just talking real quick just about the market, the inventory levels, talking about how inventory has started moving back up again.
Yeah.
So we saw that 50% increase between February and March, and then saw yet again, where I was pulling the numbers this morning, between March and now, the first half of March to the first half of now, we're up another 20%. I think we're going to see 8,000 homes go on the market, which is a pretty standard April in Metro Detroit.
So first and foremost, good morning, everybody. My name is Austin Pothast. I'm the director of sales on the team. Mike Perna is the CEO, and I got to go this way on my screen. Look, and I'm sure you introduced all this, but this is our real estate Q&A. We do it every single Saturday at 10 a.m. and it's an awesome format for people to be able to ask us questions. So I know we've got this posted live on Facebook. And so make sure that you put your questions in the box, in the little chat box, because we'll make sure that we get to any of that stuff, and we want to make sure that we get your questions answered. We've had all kinds of stuff asked us. We've had legal questions and all kinds of stuff asked us. So whatever's on your mind, please do it.
But really good.
No, you're right. I don't know that time is your friend if you're a seller. If like you're kind of kicking it around, I'd say get on the market. Matter of fact, I just had this conversation with a really, really wonderful family. They actually they live out in Chicago, and we're going to be putting the home on the market in Troy. Beautiful home, and just like how do we time this thing? Because they have a tenant in there right now. And I said, look, let me help with the timing, and let me help with the tenant, and let's get it on the market ASAP. Because I think this whole thing looks different in August, it's
Agreed.
just rates might go up, inventory is going to go up, and I just think it's a really kind of hot market. So I agree with you. Okay, what Josephine asks for new buyers unfamiliar with the process, would you please detail some info on fees, who pays what, how much extra cash a buyer needs on handover, and above 20% needed for down payment, all this stuff about closing fees, who pays what, please clarify. Okay.
That's a really great question, actually.
Really good question. Yeah.
Actually, let's start with down payment.
Yeah.
Let's start with down payment. So in America, and this is for all of our Canadian friends out there, in Canada, right, we're still seeing the average down payment needed at or above 15%. Some banks are at 10, right?
Yeah.
But not 20 necessarily. In the stateside of it, if it's moving stateside, or again, Canadian friends watching, prepare to have your jaws go on the floor. We're still as low as 3.5% down.
Actually, I'm going to edit that. I've got a conventional
actually,
client. There's a conventional program where they can do 3% down.
Yeah, you're right. You're right.
Doing that.
So 3% down on a conventional, right?
Yeah.
What we're seeing, most of our buyers are putting either 5, 10, or 15% down. The majority of our buyers are actually not putting 20% down right now.
I'm going to stop you there. I think it's a bigger conversation.
Yeah.
I think it's a bigger conversation. Here's why. I think for some people it makes sense to put 20% down. For some people it makes sense to put more down. For some people it makes sense to put less down. And I think that's a bit more of an intimate conversation with a professional. And so one of the things that when clients start asking me specifics, how much should I put down? Oftentimes I get involved, like, hey, look, let's get the mortgage guy on the line. Let's have a conversation, because those guys are fiduciaries, meaning they have to have your best financial interest in mind, and they can kind of walk you through the pros and cons, because it does impact interest rate and PMI, and at the same time, money's so inexpensive that it might make more sense for you and your family to keep that extra $10,000 in the bank than to bring it down. So I think it's a larger conversation. And I agree with you, Mike. I think there's a stigma that, oh, I have to have 20% down. And I think the reality is that a lot of homeowners are putting 3 to 5% down if that's what makes sense for their family. I know when I bought my home, we had the capacity to put 20% down, and we put 5% down because it just made the most sense for us to keep the money in the bank with the interest rate that we got,
and that's part of it. So when you're talking to your mortgage person, also turn around and talk to your financial planner.
Yep.
Okay. Because the question I always ask people is, okay, if you have the ability to put less than 20% down, what would you do with the money if you didn't put it down? Right.
Yeah.
And I think great answers are, well, I get to redo that one bathroom to make the home exactly the way that I want it. Great. Yeah. Do it now so that you get to enjoy that bathroom instead of waiting until you go to resell the home 8 years later to do the bathroom, and then somebody else gets to enjoy it. Right.
Yeah.
The answer is, hey, I'm going to put it into a retirement fund, something professionally managed or whatever that looks like, where I'm going to get a 7 to 10% pretty typical market return, because that's what my guy's been getting me. Then great. Yeah, absolutely. Because right now interest rates are at 3%, inflation's at 3.2%, right? So essentially as long as you're making more than that in the market, then you're actually making more money than you're spending.
Yeah.
Right? Because you'll spend 3% over here on the interest rate of the mortgage. But if you're making 8%, you're actually netting 5%.
Yeah.
Right. But that's, again, just having a financial planning background, that's a bigger conversation that you really should have with your financial planner as well as your mortgage person.
Yeah. 100%. I also think I don't think it's just market interest rate stuff. Although that's, look, savvy people know that, right? That cheap money borrowed and invested over time into assets is a great pathway to wealth. Even some basic stuff like if putting too much down is going to mean that you don't have a safety net. Yeah. And then next thing you know, your car dies, and next thing you know, you have to go into debt. So anyway, it's a bigger conversation. Okay.
Agreed.
So I think that was part of your question. So then your next question was closing fees, and you put it into quotes, closing fees. So outside of your down payment, there's also costs of the transaction. Okay. And so it depends on if you're the buyer. It depends on if you're the seller. Both the buyer and seller have their own unique set of fees. Like, for instance, the seller has county county and state transfer taxes that the buyer does not have, so on and so forth, right? But anyway, yeah. So there's closing fees. What do we normally see for closing? Like
Okay.
outside of prepaids,
Well, we'll get to that too. So let's list them all out.
Yeah.
And let's go in a timeline order. Okay. Yeah. So number one is going to be inspection.
Yep.
Right. And
which isn't, by the way, going to show up on your closing.
No, it's not going to show up on the closing
statement outside of the transaction. Yep.
Right. It's going to show up before. And I want to make sure I'm noting every fee so there are no surprises. Yep. Number one is going to be inspection. Right.
Yep. Yep.
And that can run anywhere between $300 typically and $700, depending on the home, depending on the types of inspections needed. So as an example, a very typical home in, I don't know, let's just say Livonia or Redford or Royal Oak or Warren or something like that, right? That will usually run around $400. Okay. And that includes a radon test, which I would always recommend. Radon tests themselves are an additional test, about $100, $95, $105, somewhere in that vicinity usually. And I'm going to go deep on all this. This question is pretty much an hour long. So with a radon test, the home inspector will typically get there like 2 days before the actual inspection, drop the canister, right? Or drop the equipment to read it in the basement. Mm-hmm. And then once they show up for the inspection with you, then they can actually give you some great results right there on site as to what the radon levels are. The EPA says anything at a 4 or below is normal. Anything above a 4, you should probably contact a professional about some sort of a remediation system. It's not unusual here to see numbers between 4.5 and 7, which is usually coming out of a sump pump. That usually means the home has a sump pump and you can cap it, right? And there are companies that will cap it for a few $100. Yep. Now, the home inspection, again, around $400. There are additional inspections as well. Like as an example, if you're in Berkeley, I'd highly recommend getting a sewer scope. If you're in Southeast Livonia, I'd highly recommend getting a sewer scope and going through that process because there have been a lot of collapsed sewers. A lot of these sewers are literally 50 plus years old and they were made of wood originally, right? So there have been some issues there, right? And we want to make sure we're not walking into a $10, $15, or $20,000 issue. Does that make sense? Yep. So sometimes the extra $100 on an inspection can save you $8,000 later on in life. Absolutely.
I just ran into that yesterday, Mike. Yeah.
Oh, did you?
Yeah, they did a sewer scope, and there's a bunch of tree roots going into the sewer line. And I mean, that's like an $8,000 repair. You dig up the front lawn for that. Yeah.
What city is that one?
Oak Park.
Okay. So it's probably a clay line that just got broken into by the roots. If I was going to make a guess,
that's exactly what it is. And then even in the basement, there's like some. Is it like cast iron piping? It's starting to kind of crumble a little bit, so they need to replace some of that stuff. The home inspection is important for sure.
Absolutely, not to be passed up, not to be missed. Okay, so that's the home inspection. Let's call it 300 to 700, depending on the need. And of course, there are properties that have wells and septics, and they need separate inspections as well because those are different, right? And some of them are county required, right? So anyway, moving on.
Yeah, for instance, like Macomb County and Washtenaw County require that the seller do a well and septic inspection prior to even listing it, right?
Yep.
And then things like that. But we can help you navigate that kind of stuff if you're selling your home, depending
absolutely.
on yeah.
Yep. And then West Bloomfield, the city requires it prior to closing.
Yep. Another great example. Yep.
But anyway. So moving on. So next up cost that people typically see is the appraisal. Okay. And that's a usually out-of-pocket cost because irregardless of the closing, the work is being done.
Yep.
Right. And again, typical appraisal fees run anywhere between $400 and $800, depending on the property. $475 is probably a good estimate. That's what I see about 80% of the time. Sometimes they run a little higher, especially if there are outbuildings involved or it's an extremely unique property. It takes a lot more time. Actually, a good example of that is, in Farmington Hills, there is a historic barn that was relocated, or historic house that was relocated. Then they added a barn to it. And to be honest, there's nothing within the next 3 cities like it, right? So that appraisal actually costs a little closer to $1,200. The guy had to take the time of 5 appraisals to get that one done properly to show it as much value as possible. Yeah. Not an easy appraisal. Most are pretty darn easy. Most are, we're looking at the neighborhood, we're finding homes that are very similar because that's how neighborhoods are built. And then from there, we just make minor adjustments based on, is the basement finished, not finished? Does it have an extra bedroom or not? Is it 100 square feet bigger or smaller? Easy stuff, right? But again, an appraisal up front. So before we get to the closing, we're in for, let's call it $1,000, just as a nice round number. A little less, but $1,000. Is that fair?
Yeah, I think that's probably high, but yeah.
Yeah. And I always like to go a little on the high side because I'd rather pleasantly surprise people than.
Yeah, most mortgage companies, by the way, I agree with what you're doing. I'd say most mortgage companies usually ask you for a credit card up front.
Yep.
Once not up front when you like are getting pre-approved, but like once you get a home under contract and we're actually like moving forward with the whole thing, it's usually like $500 or something like that they'll ask you, maybe $600 that they'll ask you for a deposit on.
Yep.
But I think $1,000 is definitely going to cover, even if you have to have 2 appraisals done. So that's high side. I agree. Okay. Keep moving.
Yep. So I just put that there. Appraisal. There we go. I'm just going to add those to the comments as we go. Now we're going to get to the closing, right? And we've got, outside of the down payment, right, we've got 3 basic fees that are going to show up on that closing. Okay. But you know what? I'm going to call it 4. I'm going to call it 4 because I'm going to add one that has nothing to do with the closing that we have to put a credit card down on or something down on anyway. So the first one that usually happens the week of the closing is homeowners insurance, right? Mortgage company is going to want to see that your property is insured. The 2 ways to get this done are they can provide it, which by the way, do not do, because they don't care how much you pay. They don't. I care how much you pay. They do not care. Second way to do it, and much better, is get a couple of quotes from a great broker. One thing I've seen is, and this is just probably great advice for everybody. Once every year to 3 years, we should probably call a good broker and just get requoted out for 2 reasons. One, a lot of people, I would wager, I guess, that 50% of the people that I talk to do not have the proper coverage for their home, right? They're missing something.
Yeah.
They're missing something, right? And as a good example of that, like one of my clients at one point, he told me, he called me up and said, oh my God, my past client, oh my God, guess what? My basement's flooded, blah, blah, blah. But the good thing is I've got flood insurance. He actually didn't have flood insurance. He had the type of flood insurance that only covers the crack in the wall, but did not cover the actual finished basement or the contents, right? So the $1,500 crack, sure, the insurance company fixed. The $15,000 in unfinishing, drying out, refinishing the basement, plus everything that they lost was not covered, right? Now that rider would have cost him about $85 a year, would have been worth it in his case. He's in a place where basements tend to leak, right? So again, when you're talking to a person, this is why, and this is personally why, and Progressive is a nice company, Geico's a nice company. All these companies are very, very fluffy and nice.
Yep.
I prefer an actual person who lives in the community, whose name I know, that I've got a cell phone number for, and who's also connected with 20 to 30 different insurance companies, right?
Yeah.
Almost 100% of the time, I watch my clients get better pricing and better coverage. Literally. And myself, I am no different, right?
Man, I used our partner company, Mike.
Mm-hmm.
They saved me $2,400 a year.
Yeah.
And got me better coverage. I've got a walkout basement. You've been in my basement. I've got a walkout basement that's finished. And so we want to have extra coverage on sub pump stuff for you know what I mean? Leaks. Because man, if we got flooded out where we are, it would be a big dollar amount. And it's really, and actually, it's actually kind of difficult to find companies that will insure it. And so we found a company that would give us a $25,000 policy or something like that on basement stuff. So yeah, it's really important. Yeah. So you got to pay for that year up front.
Yep.
For homeowners insurance. Yeah.
Yeah. And let's call if we're talking about a home at, a typical $250,000 home across Metro Detroit, we're probably looking between $1,000 and $1,500 a year.
I agree with that.
Yeah. And then
We're
once
always really hesitant to quote insurance prices because it depends on so many, like even credit score matters on insurance prices. Like it matters.
yeah, absolutely. It all matters, right? It all
Yeah.
matters. But it's a good rule of thumb for a house at 250. And the reason why I picked that number also is because as you go up in price, homes tend to get a little more unique. And as they get more unique, they get charged more money. Homes on water charged a heck of a lot more than homes not. Homes with pools charged a heck of a lot more than homes without, because there are additional riders for, and not to be morbid, but just honest, a home with a pool has a higher chance of an accident happened around, let's say, a drowning versus a home without.
Yep.
Right. And it just is what it is, right? Is what it is. So let's call that 1,000 and 1,500 on a 250. And again, call a insurance broker, right? Another good example, like just like Austin, like my parents have been there with what, Allstate maybe? Or I don't remember who they were. I think it was either Allstate or AAA for like 8 years. And I finally convinced my dad to do it, to actually get that second quote. Didn't save him a ton of money, but it was still $800 a year between the two cars and the house. $800 is $800. That's $70 a month. That's a reasonable dinner out per month, right? That he just added to himself. So if you're on here and you're listening and you have not gotten your homeowners or car insurance requoted in the last 3 years or more, today's the day. Now's the time. Just call and get it done. And don't call Progressive Direct. Call a broker, right?
Yeah.
People don't. Here's another little known fact, Mike.
Do you know that the way insurance laws are written, whether or not you go to the company directly or you go to a broker, the price is exactly the same?
That's right.
So brokers can shop the different rates. Yeah.
Anyhow. Yeah. Well, and I'll tell you, like a mutual friend of ours, she was with us in a specific insurance company for almost 10 years. Yeah. And she has a home that is on a lake with a pool, with a hot tub, with the Sea-Doos, with the boat, with the.
Yeah.
And we finally convinced her like 2 years ago to reshop it. And Haley over at Provision ended up saving her $4,000 a year, $4,000, and found out that she was undercovered. So she was able to increase her coverage substantially should something happen, and brought the cost down. $300 a month.
It's crazy. Yeah. Dude,
crazy.
I didn't tell you, I don't think I told you this.
Yeah.
So we've got a 1-month-old for those of you that don't know. And the doctor that was supposed to deliver our baby, and that doctor like literally like had to like run out and do something else. And so someone came in just to cover a shift, and that's the doctor that ended up delivering the baby. But the doctor that was supposed to deliver our baby is best friends with Haley, who's our insurance person.
Seriously?
Yeah, small world.
Well, that's a really small world.
Yeah.
That's a really small world. Yeah. No, that's good. So here we are. We're at the day of the closing. Before getting to this point, we are in it for anywhere between, let's call it 1,800 and 2,500 before we get to the closing. Between
you come inspection, insurance, and appraisal. Now, oftentimes what mortgage lenders will do is, instead of making you pay for that insurance up front, sometimes they can bill it to the closing.
Yeah.
So you can actually just make it happen at the closing, but you still got to pay for it. It's still a year.
Still got to pay it.
Yep.
Yeah. And that's true. Especially like once you're above 10% down, that's a pretty typical thing. 5% down, they really want the 1 year, blah, blah, blah. Okay. So now on the day of closing, we've got 3 basic things that we're bringing to the closing, right? Not including down payment. First one full
champagne for the closing room. Oh,
what's that?
I don't know. Champagne for the closing room?
Sure, why not? You gotta pay for the closing. No, yeah.
Jimmy Buffett songs. Oh
no,
I'm done. Keep going. Keep
going. So first one's gonna be,
if you like peanut. All right, I'm done.
I am not a Jimmy Buffett guy. I don't know any of this stuff,
dude. I don't. Well, but you know, pina colada.
Well, yeah, that one, of course. Yeah.
All
right. So first one is, if you put your taxes inside your mortgage, which I think is a really smart thing to do, you're gonna have to bring 13 months worth of taxes to the closing. Okay. So whatever the taxes are, divided by 12, multiplied by 13, that's the number, right? That just changes by house. I mean, there's no, I mean, it's gonna be changed by house, by municipality, by which actual schools that homes goes to. I mean, there are so many different factors in that, right? As to what that's going to be. And if there is a home that you're looking at and you're like, hey, I wonder what this would be, feel free to call, text, or email us anytime. We can pull that information. Yeah, Margaritaville. We can pull that information super rapidly, which is good. So
now, by the way, here's why. Sorry to interrupt you.
Yeah.
In the state of Michigan, we pay taxes. There's a couple of counties that are not this way.
But
you pay taxes in advance. So that means when you pay your taxes in January, you're paying your taxes for the right to live in that municipality until the next tax bill is due in whatever, June, July, whatever it is, right? And so what ends up happening is whoever you bought the home from in January paid for that all the way up front. And so you have what's called tax prorations. If you bought the house in April, you've got to reimburse them for April, May, June, whatever, right? July. And then the other thing that you got to do is you got to have enough taxes in your escrow account to cover the next tax bill in September, right? So the kind of the rule of thumb is you bring 13 months to close. They also put a little bit of buffer in there.
Yeah.
But between escrow prepaids is what I'm saying, and tax prorations, you're going to put a little bit of buffer. You're going to do the same thing with your homeowner's insurance, a couple months buffer. So you're technically actually bringing like 13 or 14 months of your insurance policy up front as well.
Yeah.
Right. And that's not even fees. That's just working out the math on having enough money to pay your taxes and making sure that you reimburse the seller for paying their portion of the taxes. Yeah.
Yeah. Yep. No, and that's a great point. And again, just taking a look at the millage rates here in Royal Oak home, $250,000. We're seeing around $4,800 would be needed to go to closing to fill up the escrow accounts, repay the sellers for what they paid for but are not using, and have that little bit of buffer. That's pretty typical. So it's called a little bit under $5,000. Now, other than that, there are a couple other fees. There's the mortgage company fee, and then there's transferring title into your home, right? Oh, that's a good one. I'm gonna put that up on the screen in a minute. But so mortgage fees, I've seen them run anywhere from $0 to a couple $1,000, right, to $10,000. And here's where this comes in, right? And I'll tell you right now, there are mortgage companies that will do a 0 fee up front, but they'll put it into the interest rate.
They'll charge you a higher rate.
Yep. And I do not recommend that. I do not. Most mortgage companies will give you the rate of the day with what they call an origination fee or closing fees of somewhere between $1,000 and $2,000.
Yep.
Give or take a little bit, right? And the reason why I don't believe in doing it at least in this time, at least because my opinion will change on this. The reason why I don't believe in packing it into the rate at this time is because there's a high likelihood rates are going to be going up, not down. So you want to make sure to get the lowest possible rate because you're going to have that mortgage for 10 years.
Yeah, you can have it forever.
Now,
what else is interesting about that, you guys, is the way interest rates work on the open market is this. It's actually far more fluid than what you would ever think. It's kind of like gasoline prices.
Yeah.
Except for what ends up happening in mortgage rates is they have to do things at an eighth of a point. So like you can't have a 4.027 rate. It's 4.125 or 4.25 or 4.375 or 4.5 or 4.625 or 4.75 or 4.875 or 5, right? It's like they go in eighth increments. And sometimes in the open market, a 4% rate pays you, like a 4% rate costs you 0.25% to get, and a 4.125 pays you a little bit of money, right? Like towards your closing costs, right? So it's not super perfect. So sometimes you'll run into, and that's why he's quoting you a range. Sometimes you'll run into like, look, it makes sense because now we're way more into like the 3.25s, 3.5s, but I'm just using this as an example. Sometimes it just makes sense where you got a 4%, but that rate technically costs you 0.2% up front to get it. You know what I mean? And it just makes sense. And it just, because mortgage rates very rarely line up perfectly, right?
True.
So there's like a range in there. Also, your credit score matters, right? So for some folks, if you've got a lower credit score, you for that same 4% rate that costs somebody with perfect credit, 0.2%. It might cost you with less than perfect credit 1%. Now you get the same rate. That's the benefit. You just pay a little bit more upfront for it. You just pay an extra rate on a $200,000 loan. You pay an extra $2,000 upfront to get that rate, right? Because your credit's not as good. And that's just a way. It's no different than insurance risk. Like if you had a bunch of speeding tickets, you'd have a little bit higher of an car insurance rate than someone who didn't. It's just it's the way that they build in for risk factors, if that makes sense. So that's why he's kind of quoting you a range. Did I explain that right?
Yeah. No, you did. One caveat I'll throw on it is in the early 2000s, my advice was the exact opposite. Roll it in.
Yeah.
Every refi, roll it in. Because at that time, from 1999 to about 2006, the average American was getting a refi every 18 months.
Yep.
Rates were lowering rapidly. I mean, right from 9% straight down to 4%, right? So every 18 months, we were seeing people refi. At that point, just roll it in because you're just getting another refi in 18 months.
Yeah.
Yeah.
This is kind of it.
Yeah.
Look, interest rates might stay the same, but I really don't think they're going to go much lower.
There's really nowhere to go.
Yeah.
Yeah.
Take that back. I mean, I don't know. What are they? 3.25, 3.5, somewhere in there right now. I mean, it could drop down to 2.5, 2.75. They did that for like a month.
Yeah.
Bananas. Anyway.
Yeah. So there's that. Okay. And then last one is transferring the deed and recording at the county.
Yep.
I usually tell people it's about $100. Usually ends up being 80, right?
Yep.
So to put your name onto the deed, the county will charge you $16 for the first page, and then recording the rest of the mortgage is $1 per page. So it ends up being about $86, $88, somewhere in that range. I usually say just it's $100.
Yeah.
Right. So to kind of recap it, and I'm going to kind of recap everything from start to finish. We've got the home inspection. Let's call that $500.
Yeah.
We've got the appraisal. Let's call that $500. So we're at $1,000. We've got homeowners insurance. Let's call that $1,000.
Yeah.
Now we're at $2,000 to $2,500. We've got taxes. Average sales price in Metro Detroit, which I was again just looking it up, and with the tax rates, trying to get this number as close as possible, is about $4,000. Okay, so we're in it for $6,500.
Yeah.
Right. And then we've got anywhere between 0.5% and a 1% origination fee to ensure we get the lowest rate of the day. Mortgage amount of $200,000. That's $2,000. So now we're at $8,500.
Yeah.
And let's just round it to 900 or 9,000 just for, state or county recording fees, anything like that.
Yep.
Okay. And also a good reason to round that up by that couple $100 is because if it's a condo complex, oftentimes they have a $125 to $300 fee to transfer the name themselves.
Yeah.
Which is essentially just them looking to make more of a profit, the management company, just to be completely candid. That's all that is.
You think that's what it is?
Oh, not bitter. But yeah, I paid many of those fees.
Not bitter, but I'll punch you in the face. All right. Anyway.
Okay. I'm sorry. Not bitter. Yeah, so that's it. So let's call it between 8,000 and 9,000 total. And that's pretty typical. That will fluctuate up and down depending on, size of property, location of property, things like that, right? But that's a pretty typical thing that we see on around 70% of our closing statements is right there in that range.
Yeah. It's a safe number. How about that?
It's a safe number. It will probably be lower, but it's a safe number.
Probably going to be lower, but that's a safe number.
Yeah.
And a lot of that stuff gets paid outside of the closing. So it's not, but it's still money that you owe. Yeah. So if you're going to buy a $250,000 home and you're going to put call it 5%, let's just do conventional, right? So what's 5% of
12,500?
5 plus so you're basically going to bring $20,000. Yep.
Yeah.
Now, if you're an accountant and you want the exact, we can also get that to you. Mm-hmm. Most folks want to get a general idea.
Well, and truthfully, when we've identified, let's call it an area and a price range, I can get you a lot closer. When we've identified the house, I can get you super close, like within $1,000. But it is extremely hard to get you that to the penny number simply because let's just say the closing date moves one day to another. That's going to change our closing costs slightly. So I'd much rather say, hey, this is what the closing costs are going to be, and then add 500 to the top, and then be pleasantly surprised because it was 450 less. Right? So like when somebody decides on which home they want, I will get them about 500 above what they'll actually need.
Yeah.
That's the number I'll give my buyers. And then it'll be pleasant surprised by $200, pleasant surprised by $300 or whatever.
Yeah.
Right? Because again, the closing days float a little bit. And I don't want to promise a number and then not deliver on it. I'd rather go the other way and somebody say to me, oh my gosh, Mike, it was actually 500 lower than you told me. I'm like, great. That's good news.
Buy me cookies. Oh.
Yeah, pretty much. Yeah.
Teasing,
yeah, what I do
unless you really want to buy me cookies.
Yeah.
And in that case, chocolate chip.
Yeah. Yeah.
Or cheese balls. Hey, by the way, good morning. Good morning, everybody, and welcome. This is our real estate Q&A. We do it every morning at 10, or every Saturday morning, 10 a.m. I'm Austin Pothast. I'm the director of sales on the Perna team. And Mike Perna is our CEO, and we answer anything real estate related. We just got done talking about closing costs on a purchase, right, and kind of outlaying those kind of things. And we'll answer anything real estate related, and we're happy to do that. So you throw in your questions in the chat there, and we'll make sure that we get to them. So what'd you show there?
Oh yeah. Yeah. Susan was saying that she bought a home from a church. So churches or any nonprofits for that matter are exempt from paying the city and the county taxes. And it doesn't change until the next taxing period, right?
Yep.
So if you buy a home from a church, let's say on July 1st, you'll go that entire year without having summer tax, right? Because summer tax goes July to July.
Yep.
Yeah, true story. Actually, this is a good one. Yes, there's still split closings. That's a pretty typical thing. Yeah, we're still seeing about 80% split closings.
Yep. Yep.
Yeah, this one's for you, Austin.
Okay, show it to me. Give it to me.
There it is.
Is she calling us cheese balls?
I think so. I think so.
By the way, that's entirely accurate, by the way.
Yeah. Yeah.
Oh my gosh, that's the best.
Yeah. Yeah. Oh, something I should note in there. And actually the split closing made me think of it. When I was going between the 1,000 and 2,000 for what had to be brought, I was also just swiping into it. The lender's policy of title insurance, which is usually a couple $100. It's what the buyer pays for to insure the lender. So typically the seller buys the big policy, the owner's policy of title insurance, ensuring that the deed is clean and clear of any defects, liens, loans, judgments, clouds, blah, 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 all the things, right? So when a buyer buys a home, they know they're actually buying the home. They're not buying just a piece of paper that says.
You got title costs. Jeez,
so that $400 or $500, I kind of just slid into that 1,000 to 2,000 from the bank, just because it's a bank required cost, not a transaction required cost. And what I mean by that is if you're buying a home for cash, right, you are not buying a lender's policy of title insurance. There's only the one supplied by the seller, right? Now the mortgage company is coming in and saying, hey, it's so good that you're covered, but we need to be covered as well. So if some guy pops out of the woodwork and says, hey, this is actually my house, and they're able to prove it, then there needs to be a title policy covering the lender as well as yourself to make sure that everyone in the transaction is made whole.
Yep.
Yep. Yeah. And thank you, Kristen. I just, when you said it, I thought of it. I usually lump a lot of costs together. I have that propensity because I like simple. Yeah. Wow. That was a 40-minute question, Josephine. Thank you so much. I appreciate it.
I know. Our point, Mike loves to give me a hard time. Like one of the things that we do, we just think education's super huge with our agents. So one of the things that we do every morning is we do a huddle, and we try to teach something every day, right? And there's something that something that I learned, if you get 1% better every day over the course of the year, you get 37 times better. It adds up that quickly. But anyway, and so people will ask us a question, and Mike loves to give me a hard time because we'll go on this I'll go on these tangents and explain the whole thing. But anyway, so now you guys are subjected to our craziness. So welcome to our chat. Welcome to our chat. Really good question, though. Really good question. What else is on your mind?
That took a lot. Let's go more questions. I love this.
Yeah. Can I tell you about a scenario I just ran into this morning?
Yeah.
So, by the way, throw your questions in the chat, guys. We're happy to answer them. Tenant occupied. Tenant occupied is really interesting. There's some real challenges, and so when I was talking to these sellers, I said, "Hey, look, we've got to coordinate with the management company and do all these things." And so they were really relieved that I could take some of that communication off their plate. But I think there's still a contingent of what I call accidental landlords in Metro Detroit. Yeah. What I mean by that is like they rented their house out at one point. They didn't really want to rent their house out, and then over the course of time, they just kept renting it out, and they don't know how to bridge themselves. Like they don't know how to get out of that scenario. Or one of the things that this client was having a challenge with, and God bless them, is they just from an empathy standpoint, they felt like they were kicking somebody out of their home. And so what I was able to do is just say, hey, look, I can handle a lot of that communication so that because tenants and management companies, they love to make you feel bad about it, right? Like, the violin, but anyway, so I imagine there's still a bunch of people that are landlords that don't really want to be.
Yeah.
Right? Like a bunch. I mean, we really saw in the beginning of the last decade, right? 2010, like you saw a ton of that stuff. But you see that you still see that a lot more. What advice do you give someone that's in that kind of scenario where you're like a landlord, but you don't really intend to be a landlord and you just don't know how to get out of it?
Well, and there's a couple of different ways to do that, right?
Yeah.
And all of this, I'm gonna color at the end with what's happening with the pandemic and the CDC and the federal guidelines and all of that stuff, right?
Yeah.
So in a typical environment, unfortunately, there's only two ways to really get out of it, and that's one, let the lease come up and not renew it.
Yeah.
Simple enough. Then they got to move, right?
Yeah.
Two, if they're behind on payments, take them to court and kick them out.
Yeah.
Right. And I got to be honest. It sounds horrible to take somebody to court and kick them out. It is not that big of a deal. I've done it before, right?
It's not even particularly expensive. I mean, it's
like yeah. So basically, you walk into to whatever municipal courthouse it is, right? You walk up to most of them will have a landlord, like a sign that says landlord, right? It's somewhere in there. A lot of times, if you're going to pay like here in Royal Oak, I've never had to kick somebody out and use it, but I see it all the time because of the extreme number of parking tickets I get. In fact, I probably have one right now, even though they're not even ticketing yet. They don't even start ticketing till like noon, but I probably have one. But you walk in and then there's like, usually it's the cashier, and then to the left, it'll say landlord, or like in Farmington Hills, because I've had to use that one before. You walk in, there's the cashier, but then two windows to the right, it says landlord, right? And you go there and basically just ask for the form. Right? You don't need, I mean, this sounds horrible, but you don't need an attorney to get this done. This is easy stuff. Yeah. And then you fill out the form. When were they, like who they are, what the address is, what the situation is, how much are they behind? Do you have the proof that they're behind? Did you deliver notice that they're behind? So this process looks like this. They don't pay the mortgage, or they don't make the payment on May 1st or on the 1st of the month, right? On day 5, they're legally late, right? You deliver notice, take a picture of it. And the way that I do it is I go to the house, I tape it to the door saying you are late. And then 30 days after that, when they haven't paid it, then you kick them out, right? Easy enough. It's actually just that easy.
Did you see this comment?
I saw the comment. Yes. Okay.
So, Kristen, I'm so glad you said that. There's times where I'm in Royal Oak with Mike, and I actually have his car license plate saved in my. Did you know this?
No.
I have really? My car. Yeah, and like if I walk by the meter and you don't have a ticket, I'll just like pay the $3 So they
Really?
should pick it that day.
I appreciate that. Thanks, buddy. I appreciate that.
You're welcome.
Yeah. That's really funny. I'll take it. Thank
If
you.
if I'm ever there and you go, oh, I didn't get a ticket today, it might have been because I paid it. So you
Fair. Yeah. So
I got to update your new car.
What's that?
I got to update your new car on my app.
Oh no, same Vader license plate.
Nah, but you have to say what kind of make and model it is.
Oh yeah. All right,
That's how little he knows about the app, ladies and gentlemen. He doesn't even know that you have to put that in there.
I know nothing. I'm really bad at this stuff.
It's like all you got to do is pay $2 up front, and then you don't end up. Anyhow,
I will do better. I will be better. I will.
No, you won't. So don't commit to it.
I'm gonna try. I'll commit to thinking about it during this Zoom. Yeah.
That's good stuff.
Yeah. So long and the short of it is actually incredibly easy to get somebody kicked out. Now, my preferred method is
call the attorney and pay them $75 to do all of it, and then
yeah. No, yeah, but in all
certified.
My preferred method is write a check.
Yeah.
Right?
Sure.
Here's the issue, right? Sure. So I performed several kickouts through the years, and almost every time there's been some sort of a damage in excess of $2,000.
Yeah, sure.
And it's not 10,000, but it's certainly not 1,000.
It's $2,000. Yeah, sure. Yeah.
But in addition to the $2,000 or $3,000 or $4,000, that 2 to 4 is usually where I land. I've got to go find somebody to fix it or fix it myself. Do whatever happens to be done, right? Holes in walls, whatever. Or I can go to the tenant and say, hey, listen, here's the deal. I'm going to give you $2,000. Today's Friday. I'll give you $2,000 on Monday. If you give me keys on Monday morning, we walk through this property and there's no damage. Literally. Now, here's the thing. I also have them sign saying that that's it. We're done. I give you the $2,000 and we are done. Most of that $2,000 is really just the deposit they'd be getting back anyway.
Mm-hmm.
So it's costing me like $1,000 instead of $2,000, but it's saving me up to $3,000 in damages and saving me the aggravation.
What's the aggravation?
Oh my God, the aggravation alone, right? Actually, I'm working on doing one right there now. Suzette had a great point. Yes, the government temporarily suspended some of the rules, and that's almost over, which is so good. Now, here's what I mean by that. So the government said during the pandemic, we can't kick people out, right? Period. And it doesn't mean you can't buy people out, number one. And it doesn't mean that 99% of renters are not paying on time, because let's be real, 99% of renters are. This is really only a 1 in 500 problem.
Yeah.
Which is the same reason why it hasn't stopped investors from snapping up everything they can as fast as they can, as hard as they can, because at the end of the day, rents are only going up, not down. Yeah. Property values are going up, not down.
Yeah.
And I got to tell you, just being completely candid with you, like if you're looking at 2 or 3 properties potentially to add to a portfolio, let's say you're going from 0 to 3, totally worth it. Because even if one goes sideways, you're still making more than enough over the other 2. If you're looking at one, you may want, in my opinion, you may want to hesitate. Because if you've got one property and that one goes bad, you still have all the costs and the payments going on, but no income on the other side, right? So that's just my own personal opinion on that. So effectively what they're saying is until May 30th of this year, we cannot do any sort of a kick out for late payments, no payments, slow pay, any of it, right? But after May 30th, we're right back to the original rules. Game on. Right. So here's one thing I do know. I was actually having this conversation with a landlord that has 24 properties. They've already filed at the court 3 different kick out notices, and they've got their court dates for June. And that's not that far away. Yeah. And to that, good point, June 30th. So we're looking at getting people out as early as July 5th to 15th.
Yeah.
Literally. I mean, that's not that far away.
Now, look, don't think we're a bunch of meanies.
No.
Kick a tenant out.
Right.
We just want you to pay us. You know. I want to help your family. I really do.
And that's the truth, and I know you've done this before. I've done this before where we've done like payment plans and catch-up plans and
All of it.
change the dates around and maybe wiped away half a month or whatever.
Communicate. Yeah, communicate.
And that's it, right? That's it. That's as simple as it goes. So, and the other side of that coin is, generally speaking, a lot of this can be avoided as long as we're not looking to pinch pennies to lose dollars. And here's what I mean by that, right?
Yeah.
I've got a property in Novi that I just re-rented. Rents are hitting around $1,600 a month right now.
Yeah.
I put it on for $1,450.
Yeah.
Right now, I did get 30 applications. It got beat back up to $1,575. So over the course of 12 months, I'm going to lose $300.
Yeah.
Off of let's say a $600 premium rent. But the $1,575 guy also has an 800 credit score.
Yeah.
He signed an 18-month contract because he's being transferred here by Molly.
Yeah.
He's a homeowner. Let's be real. He's a homeowner. But in 18 months, it doesn't make sense for him to own a home. So he's just going to rent for 18 months, but he's going to treat my property a heck of a lot better because he's got a very homeowner and fix things mentality.
Yeah.
Yeah. And that's just the whole, philosophy around that. And again, my philosophy is undercut the market a little bit with the rents when you're advertising it. The market will take care of the dollar amount or get you close to. But hey, I'm more than willing to spend $300 in lost rent to get an 800 credit person there for 18 months.
Couldn't agree more.
That's a no-brainer.
Yeah. Couldn't agree
In my opinion, again, that's my opinion.
Yeah.
Other landlords' opinions are oftentimes the opposite, where it's squeeze it as hard as you can, go with the worst tenants possible, and then that itself will factor in the kick out dollars as well because of how much more you're making. And the way I look at it is, again, time has a value, and my sanity has a value. If I'm losing a couple of bucks, it's worth it.
Yeah.
But again, that's just an opinion. That's all it is. All it is. Two different philosophies, and as agents working for yourselves, we will go by whatever philosophy you prefer. Alex, how does financing an investment property work? That's a great question.
It is a good question. Yeah.
It's actually not that hard.
Yeah.
Are you ready? So there's two basic types of financing for investment properties that are readily available and that are worth doing. And then I'm talking about buy and hold properties. I'm talking about properties that you're going to own long term. For the most part, investment properties, the mortgage companies are looking for 30% down.
Yeah, it's the same mortgage process, just a little bit more down.
Yep.
Probably a little bit more on a rate. Maybe or sometimes what they'll do is they'll add like a 1.5% closing cost to it. Like, just because there's an added risk. Yeah.
There's a reason. So before 2008, I could go buy an investment property for the same down payment as a regular property because nobody cared. And the reason why nobody cares is because the foreclosure rate was almost zero. During the down market, banks found out really quickly a landlord will let their investment property go to foreclosure before their primary residence, right? They'll let somebody, they will let that property go before their kids in a position where they can be kicked out. So now mortgage companies are looking for 25+%, 30% is pretty standard. Because the thinking behind it is nobody's going to walk away from 30% equity in a property because they'll just sell it, right? And then there's no foreclosure. That's number one. Number two, you can use FHA financing if you intend to move in for a minimum of 1 year to buy up to a 4-unit thing, a quadplex, right? So there are a lot of people that will buy a duplex or a triplex as one of their first properties that I see.
Yep.
They'll live in one for a year. They'll get that low interest rate and low down payment, which is so good that FHA offers. They'll live in it for a year. And then once that year comes up, they'll go buy another property because they'll again qualify for another primary mortgage. And then they'll rent out that second side or third side or fourth side, whatever that looks like. Great way to become an investor with a minimum down payment, right? Those are your two basics. Now, if you're looking at flip properties, you're probably really going to look at the hard money systems. So basically a hard money lender, because it's not worth going through the rigmarole to get a mortgage, number one. And number two, most of those properties are being being given cash offers. So those owners at that price that you'd be getting at the discount, they don't want to wait for a mortgage or the potential that a mortgage won't go through. Number one way to find a good hard money lender, in my opinion, is just through networking. Wendy Patton, who's an amazing investor and amazing person, runs a millionaire real estate investor group. I believe it's called MR or Michigan Real Estate Investor Group, MREIMR. I don't remember, but if you Google it, it has a green logo. So Michigan Real Estate Investors. If you Google that, it'll be like the first one that comes up is a green bubbly logo. They meet monthly. They're just starting to actually meet in person again. Generally speaking, you've got three types of people that go there. You've got people that have money, but no property, right? And they'll go buy a property from somebody else that has found a great property. You have people that have a property, but no money, right? In which case they can either wholesale the property or sell the contract on the property, or go and say, hey, would you loan me this amount of money at, let's say, a 10% interest rate? And I'll make sure you get paid back in 90 days. Right. And then you've got the third type person where they're looking to educate themselves, through great conversations with investors who have done it both all right and all wrong. So that is kind of how financing an investment property works. And frankly, I've done both, right? I've done all the above. I've had the flips, the buy and holds, and I've been a hard money lender in the past. You kind of, after a while, you start moving throughout all three of those, just depending on situation. Yeah, that's probably a really long answer. I'm sorry. Well, it looks like Austin's out. All right, guys, what else we got? Last call for questions. All right. What do you think? Should we wait for Austin to get back, or should we put a bow on it? All right. We're going to wrap it up. Oh, that's a great question. If you've been employed in the same industry continuously for many, many years and had a long run of being unemployed, how long would you need to be at a new job in order to qualify for the mortgage, you think? Assume 800 credit score, potential for big down payment. That's a great question. There's no set length of time. It goes to, okay, so this is how mortgages work. Mortgages will allow you to loan up to about 40% of your income. And let me say this differently. So let's say that you make $50,000 a year. Okay. If you make $50,000 a year, they will give you a mortgage where the yearly payments cannot exceed $20,000. That's around $1,700 a month. Right? Now, you've also got to take down off of that. Oh, all right. Austin is out. All right, I'm going to finish this thing up. I don't know where he went, but that's okay. There we go. So that's $1,700 a month, let's just say. Now, if you have a car payment, that reduces that down even more, right? Let's say it's a car payment for $1,400, right? So taking that debt off brings it down from $1,700 to $1,300. And then if you have credit card payments, revolving debt, $100 a month, then that brings it down to $1,200, right? Now, here's why I say this. What the mortgage companies look for is your average over 24 months of income. So you can have zero income for a year, and then you can make $100,000 the next year. And at the end of that 2-year period, what the mortgage company is going to look at is the $50,000 per year average over the 2 years, right? Now, each month that goes by that you're employed, that average number goes up and up and up. So it's not necessarily how long you have to be employed. It's how much income versus how much payment are you looking for? Okay. So essentially, however long you've been working, let's call it 9 months or 13 months or 15 months or whatever that looks like, right? Take that number, that total income number, and divide that by 24 months. And that will give you what your quote unquote mortgageable number is. That makes sense? Yeah, because at an 800 credit score, or really anything above 640, you qualify for the mortgage from a what do you call it? Credit score perspective. Now we've got to have the income to match it, right? So in that same example, let's say you make 100,000 year 2, 0,000 year 1. Now on month 13, 100,000 divided by 12 multiplied by 13 divided by 24 months. Okay, so now it will look like your average yearly income is 54,000, right? Which again moves it up another basically $100 a month, what you can afford on a mortgage. So the key there is talking to a great mortgage person and saying, hey, this is the home I want to afford. How many months away from getting this mortgage am I based on this income circumstance? And generally speaking, it's not as far as it looks. It's not as far as it looks, right? And that again just goes to, low mortgage payments right now and low interest rates. A lot of people are actually buying below their means and getting what they want, even with the higher prices. Let's see. All right. What would you say is the best? Yeah. Okay. That's a great question. I don't know. It's just different parts of my life. When I was younger and I was a kid, I had a lot more time on my hands to go in and actually muck out properties and work on them and, put kitchens up and take them down myself and do all the things. Right. And frankly, I enjoyed it. So when I was younger, doing flip properties really kind of was up my alley. Right. The other bonus of that is if you're doing let's say 2 flips at the same time, you can do what's called a 1031 exchange, which is, and I'm going to explain it different than what the textbooks say. I'm going to explain it the way that I believe it should be explained. A 1031 exchange is taking a 0 interest loan from the government on taxes you would pay on the profits that you would make on that home by putting those profits directly into the next property, right? So typically speaking, if you do a flip, right, or any kind of property, doesn't matter, in any investment property, let's say that you make 20 grand, right? You're paying 6 to 10,000 in taxes. Right? But if I take all that 20,000, I put it directly into the next property, I don't have to pay the 6 to 10,000 in taxes until I sell that next property. Right? It doesn't have to be the principal balance you put in. So let's say that you buy a home at 50,000, you sell it for 100, right? You're not getting taxed on the 100, you're getting taxed on the 50. And then even then it's less if you did a new kitchen for 10,000. So now the tax is on the 40. If you did a new bathroom, if you did new this, if you did it, so you take all that off because of just cost of doing business, right? And honest to God, when I was younger, it was just fun. It was a good time because I've been selling real estate for 20 years, and it was nice to do something different sometimes, and frankly, a little relaxing. Throw a little music on, rip up carpet. It's a good time. I've done the hard money thing with a couple of different investors. I've liked that depending on the investor. There's still one gentleman that I work with on a fairly consistent basis with hard money. And again, that just goes to time. So I'm not making the same amount or anywhere near it that I would on a flip, but I'm also not doing anything either, except writing a check and then 90 days later, getting that check back. Right. And usually, you have an abundance of one, but not an abundance of the other. At least I find you have a few more dollars sitting there, but there's no time with which to use it, or a few more hours sitting there, but not a heck of a lot of money with which to go and get a flip property, which is where the hard money comes in. I'm currently a landlord. Yes. And I'm probably going to divest. I'm probably going to get rid of those properties sometime over the next 18 months. Again, no other reason but time, right? I understand that I can take that money and put it into the stock market or mutuals or ETFs or whatever. And I understand I'm not going to make the return, but I'm also not going to worry about it either, right? Great Vanguard funds are sitting there. There's some great funds that are sitting there at 8 to 13% return for the last 5 years. Will that sustain? Probably not. The S&P 500 over the last 40 years has averaged a 7.1 to 7.2% return, depending on which study you look at. Will I make less than I do on my rentals? Sure. But I also don't have to worry about them either. You know what I mean? Yeah. Not that there's a lot that goes into it, but it's just one more thing. Let me put it that way. So that's probably going to be my future is divesting and then putting it into, and again, with safety comes a lack of dollars, right? These are things we know, right? Bigger risk equals bigger potential reward, not always reward. And I'm just at that point in my life where I'm ready to go into lower returns, but not have to worry about it. And I'm okay with that, right? And let's be real, a 7% return year over year is still a great return as long as the principal balance that you're looking at is big enough to get you where you're going as your end result goal. And maybe we'll talk next week on that, on let's do that. Investing in things other than real estate, with the financial planning background. But like a 7% return, like if you Google, investment calculator, start with whatever principal balance you have, go however many years you have until retirement, and then throw that 7.1 or 7.2% in. Over time, the money gets a lot bigger than it looks. And honest to God, guys, anybody on this call that's under 30, if you have not, or anybody for that matter, if you have not started that retirement fund, run, don't walk to get that done. And legit, I mean, seriously, like between this Saturday and next Saturday, get it done, right? That is the number one thing that I see that people between 20 and 30 that they skip and overlook is they don't start a retirement fund. And it's amazing because money is a function of time, right? 7% could be a perfect compounding interest on, let's say, $300 a month into the retirement fund, which doesn't sound like a whole heck of a lot, but it actually is, because if you're 20 years old, you're talking about 35 to 45 years that money has to both accumulate but also compound, right? When you're 30, okay, great, knock 10 years off it. You knocked off basically a multiple and a half. When you're 40, even more. I mean, like let's say $300 a month when you're 20, so $3,600 a year. When you're 40, I would make the assumption, without looking at a mortgage calculator, you'd have to be putting away $2,500 to $3,000 per month at 40 to achieve the same result as $300 per month at 20. Because that's how time works, and that's how money works. And actually, I will dive into this a little bit deeper next time, because I'm really kind of gliding over the surface. And this is, I think, extremely important and often missed and never talked about in our schools. But all right, guys, I'm going to wrap it up. Anybody have any questions? Anything I'm missing? All right. Everybody have a great Saturday. And next week we will talk about different investment vehicles that are non-real estate related, different products that one can use to make it super simple and super easy, and a couple of ways that we can do it in as tax-free of a way possible. All right. Enjoy the day, guys.